all right? Risk-free returns, all right? Discipline, dedication, consistency, having a correct plan, controlling your emotions, having the best mentor, investments, my emotions, spending less time. I see market knowledge, consistency, quality of stocks. All right. See, here's the thing. Interesting answers. I would definitely say it's a very interesting pool of people that we have on this call today. But none of them truly matter against the one thing which I'm about to tell you. And this is going to be drop in a BO if this actually is a bulb on moment for you, because the answer is none of this. I'll tell you what the answer is. Think about this. The real answer is not timing the market. It is not what stock you buy. It is not when do you buy things or the discipline. None of these things matter versus the one thing that I'm about to tell you: asset allocation. The fundamental, the basic understanding of stock markets. A lot of people start at the top. Fundamental, they forget. Drop in a BO if you had not thought of asset allocation so far. वही तो important है. All of the things that you told are important, but they come later. Asset allocation. What do I mean by asset allocation? Asset allocation means how much percentage of your entire portfolio is invested in different asset classes. Thoda in gold, little bit in fixed deposit, little bit in stock market, little bit here and there. That's what asset allocation is. How is your entire portfolio allocated amongst different asset classes? This is the fundamental layer. Everything will come after that. Asset allocation is the most important driver of investment performance. If you look at the pyramid of investment performance, you will find, guys, if you have ever seen a pyramid, right? If you have seen a triangle, everyone agrees the strongest part of it is the base layer, the bottom of a triangle, right? Everything on top of it is building up on that base layer. That base layer, when it comes to investment performance, is asset allocation. Asset allocation basically means the mix of assets and what percentage of your money is in different asset classes. Something in fixed deposit, something in debt, something in mutual fund, something here and there. That's what asset allocation is. Once you have asset allocation sorted, then comes a lot of people told us, sir, what we are buying matters. Yes, it matters. But after asset allocation, what you specifically buy of each asset comes after that. Everyone agrees, guys? Can I have a yes if you absolutely agree with this? This, my friend, comes later. And then you have market timing. A lot of people told when we put money in the market, that's the last thing. We have been fed up of so many people who have no market knowledge and always think because other people are looking at market timing, when to buy, when to sell. It's important. But fundamental only if you forget, what will you do by market timing? Asset allocation is the number one. What you buy and sell is number two. And when you buy and when you sell is number three. So, how much is your portfolio divided into different asset classes? What all stocks are you buying, or what all different investment instruments are you buying in different asset classes? And when are you buying comes last. Everyone clear with this? Can I have a yes if you're absolutely clear with this, guys? Yeah, makes sense? Perfect. Awesome. Now let's go ahead and very quickly understand the different asset classes available to a retail investor. Okay. The different asset classes that you, my friend, have available to yourself are the following. As a retail investor, as a HNI, you have 10 more options as well. But if you are someone who doesn't have a big capital, this is all that you get. Number one, cash. Everyone agrees, everyone having the same common sense, cash doesn't give you any return. Your wallet, if has 2000 rupees, tomorrow if you wake up, it will not have small kids of 500 rupees. Everyone agrees. Yeah. Cash will not multiply itself. Cash has 0% of return. Your wallet will not grow if you don't do anything about that money. Then comes fixed deposit. Now, depending on the tenure of the fixed deposit, it can be 1 week also, 1 month also, 1 year also, and 10 years also. Your bank will offer anywhere between 5 to 8% as fixed deposit yearly return. Can I have a yes if all of you guys who have done a fixed deposit in your life know 5 to 8% is what you can expect? as a senior citizen in HDFC or SBI bank, 7.1% is what you will get. If you are looking at a small finance bank, which is actually a bit more riskier, still you will get maximum 8%, not more than that. All right. Then you have debt mutual funds that put money in debt instruments, bonds, debentures, all of these things. They will give 8 to 10%. More or less, you guys are not aware about debt mutual funds. They are not very popular. But for those who know about it, 8 to 10% is what you can get in a debt mutual fund. Then it comes to gold. Now, a lot of people have seen the tezi in gold in the last 2, 3 years, and they think gold will give 15, 20, 25% of return. But guys, always remember investments are supposed to be on a long-term basis. So long term, if you look at the historical returns of gold, when it has given less returns also, high returns also, on average, it gives 9 to 11% of return over a longer period of time, not 1 to 3 years. Over decades, it will give you 9 to 11%. Everyone agrees with this? Can I have a yes if that makes sense to you? Easy to understand as well? Yeah? Perfect. Then you have real estate. Real estate, a residential property will give you 7 to 9%, combining the rental yield and the capital appreciation as well. 7 to 9% is on average. And you might wonder, but sir, my Dadaji, my Nanaji bought a property back in the 1990s, and now it has grown 20x, 50x, all of this. Of course, there are going to be a lot of scenarios, a lot of rare scenarios, where if you buy something and tomorrow if there is a highway constructed there, or if you buy something in, let's say, Ayodhya, and then you had Ram Mandir coming up there, right, or opening up available to everyone there, the property prices will increase. But that happens 1 out of 100 people. That happens for 1 out of 100 people. I am not going to look at the one lucky person who has invested in the right manner. I am going to look at